Joining us now is Jared Walczak, Tax Foundation Vice President of State Projects, and Matt Gardner, Institute on Taxation and Economic Policy. And he's conducted tax analyses for state and local policymakers and advocates in more than 45 states. Normally, Matt, I'd feel bad about an intro like that because we're drawing a lot of conclusions, aren't we? But, you know, just looking at some of the facts, I think maybe the conclusions are relevant because the high tax states, the ones that are already highly taxed, are the ones that seem to have these budget problems, and that's where everybody's leaving. The 6 out of the 7 highest taxed blue states have lost 5 million residents, 6 out of 7 of them. And with the residents, so goes the tax dollars. It just seems like then you raise it more and more leave, and you raise it more and more leave. That's the definition of insanity, isn't it? Doing the same thing over and over again, thinking it's going to change?
Well, thanks for asking the question. I think the thing that's been happening over and over again is that people have been forecasting economic calamity in states like New York and California and, you know, half a dozen other states that have had progressive income taxes in place for decades. And they keep making these forecasts and they keep not coming true. You know, migration happens. It obviously happens. But the people who tend to move most frequently from state to state, when you count migration from here to there, they're young college grads, they're low-income families, they're people who are looking for higher pay, a better quality of life, better schools. And state tax rates they're just not central in these decisions. So yeah, I would agree migration is happening, but I think the idea that you can trace it in a systematic way to tax rates is pretty dubious.
I just know there's times I've thought about it, Matt, and I think about, especially after, you know, what happened with SALT, so the state taxes aren't deductible. And if you're in a state with a 13% state income tax, and you get an opportunity and you can't deduct it anymore, and you had an opportunity to move to some place at 0, you don't think that anyone actually uses that as a... Jared, I'll ask you, is it absolutely just about young people deciding to move to, I don't know, just because they like Texas, because they like steak or something? Is that why they're moving there?
If that were the case, I don't think we'd be talking about this consistent outmigration from places like California and New York and other states that have those high taxes. Obviously, it's not the only issue, but if it were just young people, if it were just the sort of patterns that Matt's talking about, we wouldn't see this consistent outmigration from these higher tax states. And importantly, the people who are leaving are the people who help fund the budgets of these states. You talk about a wealth tax. Okay, it's hitting a relatively small number of people. They're also incredibly highly mobile people who are going to be very incentivized to leave. A 1.5% wealth tax like California is talking about, okay, that sounds like a low rate. If you have a typical investment, that's equivalent of like a 16% tax on your earnings. That's big. That's higher than the state's 13.3% income tax rate. Are you going to think about going to another state? Yeah, I think so.
Matt, there are things that we all want, and some of these blue states, I think they would sell themselves, whether it's education or quality of life, and all that does cost money. But is there any way to address the spending side and not just the tax side and do both, maybe? Or is there, I don't know, is there a tax that isn't quite as deleterious to economic activity? Is property tax, does that work? Is there anything that you know, is less harmful to the economy?
Well, there's a hierarchy of taxes that states can look at. And among the states that are currently thinking about what you're calling wealth taxes, some of them are just marginal modifications of existing taxes. For example, there are a few states that are talking about paring back capital gains tax break on the existing income tax, broadening the estate tax or strengthening the tax a little bit. These are easier to administer because they already exist, because they're based in part on federal rules. So I think it's worth looking at those things as well. But there's no reason to think that any of these taxes, from the property sales and income taxes that form the the balance of what states do right now to the broader property tax, I would argue, that you're looking at with a wealth tax, to think that these things taken on their own are going to be an economic, the economic doom for these states, because they're always connected to social policy outcomes that states want to achieve.